Hold on.
Okay.
Okay, so anyway, Linda made her natural transition in careers from managing rehabilitation departments in nursing homes to helping people afford higher quality options. With her experience as an occupational therapist in home care, assisted living, nursing homes, as well as a trainer for Harvard's Division on Aging, Linda is well versed in the functional needs for long-term care and the medical lingo of underwriters. As an independent agent, she represents all non-captive products and can quote on most captive products as well. It's her priority to provide accurate, appropriate long-term care options to enable clients to make informed, educated decisions. Back in 2015, Linda added claim support services to make sure those promises of long-term care insurance companies are kept. As a national long-term care expert, she has served on the board for the certification of long-term care. She co-wrote the guide on long-term care claims, and most recently rewrote the chapter on long-term care insurance for the 2025 Massachusetts Elder Law Education Guide. Linda regularly provides training to insurance specialists and advisors like us. She believes the team approach to planning is one of the most effective ways to provide excellence to clients' overall financial plans. Without further ado, here is Linda.
All right. So can you share your screen so I can get to the slideshow, or do you want me to share mine and I can just, because I can do
Yep, you
that.
can share yours. You've got,
Okay.
should have some shareability.
All righty. So here we are. And let me move this out of the way so it doesn't impact people. Okay, good. All right. So today we're going to talk about the 7 ways to fund long-term care. There's actually a couple more, but there's only so much we can do in an hour. So we're going to stick to 7. So basically, we're going to talk about self-funding, government funding, using traditional long-term care, hybrids, life with long-term care riders. We're going to talk about some alternative products and also prepaying for young children. Before we talk about how you would self-fund or how you choose which way to fund long-term care, you need to come up with what is the problem? What are you trying to self-fund? And so we need to come up with a number. So if you start off and you say, I'm going to self-fund my long-term care, you need to know what is that actually going to cost you? So we look at our retirement savings and we say, how much money do we need to take out of our retirement savings and put it in a long-term care pool? So then we can assess, is it better to self-fund or to leverage this money by using a form of insurance or alternative product? So in order to do that, we have to answer some basic questions. And that is, how much does long-term care actually cost? So most people want to stay in their own homes. Now, the average cost in Massachusetts is about $39 an hour. And unfortunately, you can't just hire someone for an hour or 2 hours at $39 an hour. It becomes $50 an hour if you want 2 hours and $100 an hour if you want 1 hour. So most people go for a 4-hour shift, which is in fact a blessing for people who need care in home, because what it does is it frees up the partner or the child to leave the house, do their exercise, have lunch with friends, maybe join a support group. So when they come home, they can help their partner or parent live longer, safer, and better in the home environment. And the longer people can stay in home care, the more cost effective that is based on 1 shift of care. So that 1 shift of care is about $4,700 a month. Now, if you need 2 shifts, morning and evening, you're now talking $9,400 a month. And of course, if you're talking 24 hours, you're close to $28,000 a month. Now, most people will start moving into assisted living at about the 2-shift mark. So assisted living on average is $7,400 a month. And that's a Massachusetts number. Now, over here where it says nationwide 2024 cost of care study, that is the nationwide insurance company survey. It is actually a Massachusetts 7,400 average. So you know what the average is. There are some that are a little lower and there are some that are a little higher. Most people tend to go up in the cost of assisted living as opposed to down for greater care. The other thing it's important to note is that dementia units are often 2,000 or more than a traditional assisted living. And although assisted living does pay for providing care with bathing and dressing and all of those things, it may not be on your time schedule. And you may have multiple aides throughout the week. So many people will choose to hire private aides within the assisted living, adding to that expense so that every day they know their aide is coming in at 7:30 in the morning, and that aide knows how they want their hair done and what clothes they like to dress in, and do the things that are unique to their care. Basically, it comes down to this. The more you have, the more you'll spend, and the greater the potential for quality of care. So now let's talk about the probability of needing care and the duration that you'll likely need care. Now, interestingly enough, if we look at the need for long-term care on a national level, and we don't talk about long-term care insurance, it's about 70%. But we want to be, very focused on how do the people who need long-term care, who have long-term care insurance, which is an entirely different population than the general population, how do they access long-term care? And 33%, 1/3 of people who have a long-term care policy with a 90-day elimination, which is a deductible period, are using their policies, 1 in 3. And if for those people who choose to have a 0-day elimination period, it goes up to 50%, 1 in 2. The average utilization of long-term care is 2.2 years for males, 3.7 for females, and this goes back to 2000. Okay, so the government numbers really haven't changed very much. But what is interesting is to understand how insurers are paying out these claims. So when we think about averages, we think about most people using 3.7 years. But in fact, long-term care utilization is more of a U-shaped curve as opposed to a bell-shaped curve. So what I mean by that is that most people will either use 1 or 2 years or less, and then the others just keep on going, where they start using 4, 5, 6, 7 plus years. Now, if there's one thing I can tell you, that we have no clue what our future holds. And I use my parents as an example. When my mom started to use care, she was very sick, and I would have guessed 2 years, and if we were really lucky, 3. You usually think about at the time that someone enters into claim, you now have the crystal ball of about how long it's going to last. And you really don't. Not even then. After those 3 years were up, if you had asked me again, I would have said the same thing. 2 more years, and if we were really lucky, 3. Now, at the end of the 6 years, I just threw up my hands, I have no clue how long my mom was going to need long-term care. She is entering her 9th year of long-term care claim, well over $1.2 million paid for by the insurance company. And my dad, who is now 97, went into claim at 96, and he plans to live to 100. So that's 4 years of long-term care, even starting at age 96. I give him full expectation that he's going to make that goal. 15.9% of claims will last more than 5 years. So now let's calculate the future cost of long-term care. Home care, as we said, is $4,700 a month. 2 shifts is $9,400 a month. So if that's you and that's what you want, you say, I want to stay in my home, I'm going to need at least 2 shifts of care, you should be using the $9,400 number. And if you're someone who says, I want to spend 24 hours in care, then you need to double that. For people who are going to say, gee, $9,400 a month just feels a little high, I'm going to have to go to assisted living, $7,400 a month. And if you're someone who says, gee, I'm not going to tolerate an average assisted living, I'm going to need something a little nicer, or I anticipate that I'm going to need a little addition of additional supports, home care coming in to keep things consistent, you'll use a higher number. But I want to show you, even using the lower numbers, that this is a real concern against a financial plan. So I'm going to use the number $7,400 a month for an average assisted living. I'm going to fund it for 5 years of care, and we're going to anticipate a 5% rate of inflation. So that means That's $444,000 today, which is 7,400 times 12 times 5. That's it. And in 15 years at 5%, that's $888,000. And in 30, over 1.7 million. So a 55-year-old today going into claim age at 85, big numbers, big numbers. So now we go back to our original question. How much do we need to take out of our retirement savings today to be able to fund long-term care in the future? Now, if we assume that you can make at least 5% as a rate of return, then you can just put that number right over here. If there are two of you that you're trying to plan for, you may want to double it. Okay, so for those who are still thinking, that's not that much money, I'm okay with self-investing, let me ask you, do you ever fear a bear market? Because long-term care is the market dropping with no end in sight and no potential to ever recover. Most people who don't fear the bear markets, it's because they know that the market's going to go up again. But with long-term care, obviously that is not the case. Now here's another concern. How much of an estate is actually allocated to fund long-term care expenses? And the answer, all of it. Because in order to qualify for the next opportunity to fund long-term care, which is the government, you need to spend down your assets. And Medicaid is a loan and not a gift. Now, Medicaid is for the poor. And you can remember that because Medicaid ends in aid. So that's financial aid as opposed to Medicare, which is medical care. That AID stands for all investments depleted. The spend down is $148,620 for a spouse and down to $2,000 for an individual. And once you go onto Medicaid, the state can put a lien upon your home. So what does the government do about this? The government really doesn't want to take your home, and they certainly don't want to be paying for long-term care. So they've sent out some incentives. And they said that if you buy a long-term care policy, a qualified long-term care policy, that they will allow you to use your HSA accounts, your health savings accounts, or if you're self-employed, and if you're self-employed and you have a spouse, you can use the same deduction as you could if you had an HSA account. And these are age-based deductions. Or if you have a C corporation, you can take full premiums as deductions. And you definitely want to be talking to your CPA if you're talking about taking the entire premium or single pays as deductions. In addition to taking the premium as a partial or total tax deduction, you still get the benefits received tax-free. So both sides, you can be getting benefits from the government. Now, the government is also incentivizing on the catastrophic protections. In Massachusetts, we have a unique law called the Mass Health Lien Law. And this says that if you have a very small long-term care policy, just $125 a day for 2 years, doesn't even have to have inflation protection, can have up to a 365-day elimination period, it will protect over $1 million in a primary home. What does this mean? It means that when somebody starts using Medicaid, if a lien is placed upon the home, when that person dies, the lien is lifted and the home is returned to the estate. And the expenses for long-term care are not deducted. So this is a very, very important protection for people who have the vast majority of their estate in the primary home and they would like to leave it to their spouse or a partner or heirs. Now, partnership is a catastrophic protection in other states other than Massachusetts. Massachusetts is the only one that protects the home directly. In other states, such as Rhode Island and New Hampshire and Florida, and there are many, many other states, the vast majority of states have a partnership program. And this protects dollar for dollar of benefits received against Medicaid spend down limits. So for example, if you had $500,000 of benefits received from your long-term care company for a long-term care claim, you could then protect $500,000 of your assets and go on to Medicaid. You could have $1 million in long-term care benefits received by the insurance company, and that would protect $1 million in the estate, and you could still qualify for Medicaid. So let's go to the next way of funding long-term care, which is traditional policies. Traditional policies are generally use it or lose it. And while there are policies, traditional policies that have return of premium benefits, they tend to be very expensive. And if that's something that's important to you, there are other products that will serve you better. But the traditional policies are necessary to qualify for Mass Health Lien as well as partnership protections. Some people will buy very, very small policies in the traditional realm just to meet that partnership or Mass Health Lien protection, and then purchase other policies that may meet other needs that they prefer. So these traditional policies will definitely have the biggest bang for the dollar on annually funded premiums. So there are multiple ways to pay for a long-term care policy. You can pay every year until you go into claim, although there are some policies that you pay premiums even while you're in claim. But you can also pay on a limited time, so that you could say, I want to pay up my policy in 20 years or 15 years or 10 years, or I just want to do a single payment and be done. Those types of policies will be better leveraged in what's called a hybrid, which we'll talk about in a minute. But for people who want to pay every year, those policies are going to be much more competitive on the traditional level. You will also get the biggest bang for your dollar for shared benefits, so that partners or married spouses will do better with, just for the big bang, the amount of money you spend for the amount of benefits you're going to get with a traditional policy. There are unlimited options within the traditional policies. And the traditional policies are often used to maximize the tax deductions because it's an annual pay, and you can take money out of your HSA account or take a deduction against a small business. Benefits are going to be received tax-free. And there is a new simplified issued product in Massachusetts that fulfills Mass Health Lien protection. And those simplified issues allowed people who had health issues who didn't qualify previously can now get a policy within Massachusetts. So very exciting to know that you don't have to be in perfect health or even very good health. You can have some significant health issues and still qualify for this very important protection. Let's talk about pricing, because that's a next question that's going to pop in every mind. What does this cost, right? So this is a policy for, if you think about it, I used a couple. So if you had a 55-year-old couple, and it doesn't matter if it's male, female, 2 males, 2 females, same pricing with this product that I'm showing on this slide. 55-year-old couple, total premium is just $93 a month. And that would meet Mass Health minimum. So that would protect your home up to a little over $1 million, and you'd have some long-term care benefit. And as you see, it's not that much more expensive for a 60, 65, and even 70-year-old person, 70-year-old couple can do very well in protecting their home. So they don't have to put it in an irrevocable trust. They can maintain the flexibility of maintaining their home, as well as protecting it against Mass Health Lien. All right. So now let's talk about the benefits of a real solid long-term care policy that's not just going to protect your home, but it's actually going to protect your estate. So this is a policy. I used a 55-year-old couple again. Again, it doesn't matter, male, female, right? And here we're talking about a 5-year benefit. So we said we want to have at least 5 years each. So that's 5 years for one partner, 5 years for another, 5 years that can be shared, such that one could use 10 years of coverage. This policy would cost just under $6,500, but the real importance of this is not the absolute number, but the relative number to self-investing, because the benefits are directly proportional to the premium. So we can play with those numbers to make sure that fit into people's budgets and provide the amount of protections that people need. But the relative question is it better to self-fund? Now, when I talk to advisors, most will say that if they have to give me an answer at a 95% confidence that their investments will have a certain rate of return, it will typically range between 5 and 6%. So certainly, advisors can talk about a higher percentage when they're not giving this very high rate of confidence. So I use 6% just to be, extra, to show that even with a very nice rate of return, the long-term care insurance is still extremely valuable. So here we have the same amount of money being put into a long-term care policy versus being annually funded into a long-term care policy. And as you see, after when this person, 55-year-old, 30 years later, at age 85, they've only 2 times multiplied their initial premium costs. So they would have almost $544,000 available. And if this is taxable money, the multiplier actually drops down to 2.4. Whereas with a long-term care policy, the multiplier is 12.9. So if you use just 20% between the couple, the long-term care policy, it would have been a good decision, right? So this is why people use long-term care insurance, because there's no way to invest the money and get the kinds of tax-free returns that you can get with a long-term care policy. All right, let's talk about hybrids. Because many people still have in the back of their mind, what if I never use this? And the answer is, first I want to say, that's a very good thing, right? So if you were planning on self-funding this, then you were willing to risk 100% of the cost of long-term care. So if you never use long-term care and you purchase a long-term care policy, very few people will cover long-term care 100% of the cost. So even if you paid for a long-term care policy and never used it, you have still protected typically 50% of your assets by not needing long-term care. And if you obviously needed long-term care, you've protected your assets by that great leveraging of the insurance over self-investing. But hybrids have additional benefits beyond just the death benefit. Now, hybrids are different than life with long-term care riders. Hybrids are qualified long-term care policies where the premiums may be tax deductible and the benefits received tax-free. There are two chassis. It can be a life insurance or an annuity chassis with a long-term care rider, but it is integrated into one product where they are leveraged to fund the long-term care as opposed to life insurance. So the life insurance aspect of these policies is just intended as a return of premium. Some are a little higher than the premiums paid in, some are a little bit lower, but certainly not like a life insurance policy where the primary goal is to leverage life insurance. So the long-term care is the leveraging on a hybrid. And inflation protection can be throughout the entire benefit period. There is a new shared hybrid that came out this past year, which has checked every box for couples, being shared, being cash, being a guaranteed premium, a shortened pay period, and payback of the 90-day elimination period. There's just a lot of benefits to a hybrid that meet a lot of checked boxes for families. There are a couple hybrids that have cash, which tremendous flexibility, and these are very competitive in shortened pay periods. Now, if you had asked me 2 years ago what I sold the most of, I would tell you that 90% of my sales were traditional policies. In the last 2 years, 90% of my sales have been hybrids, and that's because the pricing has come down. Hybrids have come down up to 24% over the last 2 years due to the higher interest rates. So let's actually do some comparisons. Let's look at pricing, right? So a traditional shared policy, 3 for each of the couples, plus 3 to share. So one could use 6 years, 9 years in total. This is a reimbursement policy, a service day elimination period, annually still highly, highly competitive. But on the 10 pay, which is a shortened period, so basically a 10 pay means you're going to pay for 10 years and never pay another premium. If you pop over to the shared hybrid, there's 8 years shared between the two. So one could actually use 8 years, leaving nothing for the spouse, and the premium isn't that much more expensive. So the advantage of this is the longer duration option for one to protect the estate as long as possible. You have the cash, a calendar day elimination period, and a payback of those first 90 days. And it's not that much more expensive, right? So now if you said, gee, I want more years, as soon as you go to 4 years shared, which is 4 years, 4 years, 4 years, or 5 years, 5 years, 5 years, then the traditional becomes more cost competitive. But I do recommend that people pay that on an annual as opposed to a 10 pay. Now, on an individual basis, the female has done exceptionally well with the new priced hybrids. So if we look, again, very nice annual rate, but on a 10 pay, the hybrid blows the traditional policy out of the water, right? So for hybrids, for females who want a longer duration period, will do better with a hybrid. Now, if you're using smaller policies, 2 or 3 or even 4 years of benefits, the traditional will look better again. Now, males have done fine, but not as well as females because, as you know, males have shorter life expectancies. So the life insurance combined hybrid product is going to be a little bit more expensive, and it's close. So there are males who will still choose the hybrid because they like the cash, they like the payback of the first 90 days, right? So certainly it doesn't exclude the hybrid from a single male, but oftentimes the single male will go with a traditional annual pay. Now, there are other types of products out there in the hybrid world. Hybrids that have an annuity chassis are more flexible in their underwriting, but I want to jump right to the guaranteed long-term care benefit that we now have available to us in Massachusetts. This new product is a single premium product. It is based on an annuity chassis, and the annuity is actually invested so that there is cash value in this product. It is a true 7702B, so the benefit is received tax-free. It's a cash benefit with no elimination period, and of course you have a death benefit. And it is guaranteed insurable even if you're already needing care. So this is an amazing product to have available to us in Massachusetts. It's actually available in many, many states now, but it just came to Massachusetts within the last couple of months. So very, very exciting for us to have this product. Now, I do want to touch base on the life insurance with the long-term care riders. Now, this may be a good option for younger clients that the primary need is life insurance, and then you zip on a long-term care rider and they have that added benefit. But it's usually the most expensive way to insure for long-term care expenses. And it typically has no inflation on this product. The increases within the product will usually apply to the duration of benefit. Now, remember, a life insurance policy grows because of something. What was I going to say? Oh my goodness, Mike. Because of dividends. And dividends, the definition of a dividend is an overpayment of the premium. So basically, you're using a cash value life insurance policy like a bank. You're putting extra money in, that money grows, and then you can receive it tax-free as an advance using a loan on the policy. So it's important to understand the contractual obligations when you look at different types of products. Some of these life insurance products have a chronic illness rider. Chronic illness and long-term care are two different products. Chronic illness riders can simulate long-term care riders, but it's very important to read the fine print. And if the chronic rider is a free benefit, just buyer beware. It is typically not what you think you have, but I'm happy to review any of these options with you. Now, for uninsurable conditions, there are two additional products. There are annuities with ADL riders. So these are not long-term care. It is basically the 2 out of 6 daily living skills in which you need some help. There is no mention of cognitive impairment on these annuities with ADL riders. The second thing is that they typically are in Massachusetts, you'll see them tied to income riders. So they do double the income when people need care, which is a very positive thing, but be aware that the ADL riders on most products, or I should say with the exception of one that I know of, the doubling will disappear if the account value goes down to zero. Now, home care contracts are a great option for all ages. So the home care contract can be used in conjunction with a long-term care policy. It is not long-term care, so it doesn't follow the same rules. It's intended to keep people in their home. So it starts much sooner than a long-term care contract. Now, a long-term care contract requires that you need assistance with 2 out of 6 daily living skills, or you have a severe cognitive impairment requiring substantial supervision. To enter a home care contract, you just need a change of function requiring care. It's that basic. To qualify to purchase the policy, all you have to do is be able to be independent with all of your daily living skills, all of your community living skills, and still be driving. So somebody who has been diagnosed with Parkinson's or even early stages of dementia may still be driving and independent in all aspects of their own care and community living. They can get this home care contract. They can now get that guaranteed contract as well. And but this can start as soon as somebody needs help making their bed or doing their laundry or doing food shopping or making meals. And it can continue until people need help with bathing and dressing, etc. So this is a great additional option that can help people. Again, there is no age limit and there is nothing related to diagnosis. Now, the last way I want to talk about funding long-term care is to fund care for adult children. And the best age is actually starting at age 30. And then you have access to cash hybrid products. And the reason I say that is because if you're starting with young adults, they might have these policies for 50 years, and we don't know what the future holds in 50 years. And we don't know if one of our children is going to live in this country or another country, or if they're going to be all robots out there, or what is managing our care, or what anything is called at that time. So I think cash policies feel really comfortable to be purchasing, to be purchased for young adult children. You can be using gift exemptions at this time. You can pay it up before you retire or just after you retire. And what you're protecting is the ability for your adult child to have a long-term care policy. I mean, when we think about it, what is the most important thing for a parent? It's to make sure that our child is, or our children are being taken care of. And what better way to make sure that after you're gone, that your children are going to have the level of care that you would want them to have if they needed long-term care. Now, long-term care is, we don't really expect our children to need long-term care when they're young. Unfortunately, it happens. I worked in spinal cord injury for several years, and all of my clients were young. And if I had said to any one of these young clients of mine at that time, would you like to buy a long-term care policy the day before their accidents? They all would have laughed me off the planet, right? Because they were young, they were healthy. What could possibly happen? I'll be honest with you, I purchased long-term care insurance for my own children when they were in college. And at that time, we could buy it younger. There are still options for people in college. They're not the cash policies, but there are options available for people in college. And then you can, as they get older, get them additional policies. I got it because my son was playing football in college, right? And it was my umbrella for him. But we also are, healthy young adults. They may go hiking or camping or have dogs. Chronic Lyme disease. It's an exclusion on the traditional long-term care and the hybrid policies. Metastatic cancers, they're exclusions. Chronic COVID, it's an exclusion. So getting plans for younger people, has value. So I just wanted to throw that out there for any of you who might be estate planning as well. So basically, we are not surprised when people live into their 80s or 90s. In fact, most of us would be disappointed if we didn't live into our 80s or 90s. And so living a long life is a near certainty. And so planning for it is now a necessity. And that's what this is all about. And even small policies have value. In Massachusetts, they have exceptional value because of Mass Health lien protection. But in general, I want you to think about when you go to the store and you buy an item and you get to the register and they tell you it's 25% off, and you walk around all day knowing that you've saved $10. Imagine if you were saving $25,000, right? So, or $100,000 a year. So, understanding the small policies do have tremendous value. And I want to thank Rick Fingerman for having me talk about long-term care planning, because I'm a strong proponent of the interdisciplinary planning team working around to optimize our clients' financial planning. So we're going to open up for questions. And if you want to talk to me, you have any questions, if you have a long-term care policy that you want reviewed, any of those things I can help you with. You can click on the barcode and schedule a time. You can go on my website and schedule a time. And on my website, I do have a HIPAA compliant questionnaire, so that if you want to meet on the first time that we meet and have quotes ready for you and in a table to compare, I can do that if I have, health information and financials to do an appropriate, accurate plan on your behalf. But thank you. Are there any questions? Rick, are you able to see the screen for the chat to see if there are any questions in the chat?
I am. Linda, that was terrific. Thank you so much. Yeah, every time I hear you talk, I learn something new. I didn't know about the new change to the Massachusetts policies, which is just another plus for living in Mass, I guess.
Very exciting. Yes, yes,
Yeah.
yes, yes. So a lot of these plans were actually in other states. It usually takes us longer than others to get these policies. So that's why I get so excited when they come into Massachusetts. Yeah.
And so I have a question. If somebody buys a policy in Massachusetts, they retire, they move to New Hampshire or Florida, does that change anything as far as
Nope.
the level of care?
Nope. So these policies can be used anywhere within the United States. And some policies can be used outside the United States. And so, one of the questions I always ask clients is, do you plan to retire within the United States? Is there any potential that you'll be outside the United States? So sometimes people will be outside the United States, but when they need care, they'll come back to the United States. So they just need something, short-lived. All of the policies have some short-lived clause, so that if you are outside the United States at the time that you need long-term care, you can typically use a month outside the United States and then come back.
Okay, great.
But there are some that can 100% of the benefits can be used outside the United States, and you can be using doctors outside the United States to write your plans of care. So some of the companies have gotten much, much more liberal on international usage of these policies.
Wow, I didn't know that. Okay, great. We have another question. What does payback of first 90 days mean?
Good question. So in a 90-day elimination period, typically you are responsible for those 90 days. So there are two different types of elimination periods. There is a service day and a calendar day. A service day requires you to have a paid level of care. It's, can just be an hour of care a day, to count against the elimination period, or that 90-day period before the company starts reimbursing you for care. A calendar day means you just have to get through those 90 days. Usually the first day, there has to be some billable long-term care to show that you've gotten through, that you've started that plan of care. But for the next 89 days, family, friends could be providing care. And with this one policy, they pay back those 90 days. So and it's a cash policy. So when you get to day 91, and they make that first payment of 4 months for the first 3 months, plus that 4th month, they've paid back for those 3 months of care, whether or not you have actually had any expenses. So in other words, let's say you were discharged to a rehab setting and you spent 2.5 months in rehab, you came home for 2 weeks, and you had 2 weeks out of pocket. The insurance company is still going to provide you 4 months of the cash benefit. So it's a nice way to bump into long-term care because there are always more expenses when you enter into long-term care. You often have adaptive vehicles or adaptive equipment. Many of these companies have adaptive equipment clauses. Some of them have a month's worth of free equipment to stay in home care. Some have specific equipment that they pay for that is free. Many of the policies include geriatric care services to help you through the process, to help you stay at home longer and better. So yeah, so that's what that means.
Great. One more question for Linda. Does it make sense to try to cover 100% of expected long-term care expenses? And if not, how does one know how much to cover?
Good question. So there are very few people who can afford to cover 100% of the cost of care. So I have basically two people who have chosen to cover, 24-hour home care, and their net worth is 35 million plus. So, and I tell those stories because you would think somebody who's 35 million plus would say, hey, I can self-fund, right? I have people with 2 million who are saying they think they can self-fund, right? and here we have, people 35 million plus who are saying, I want full coverage. And why would they do that? Because we just showed you that long-term care greatly leverages your assets. So it made sense for them. And of course, these higher net worth people have businesses that they can take tax deductions on the front end. So then they can receive, so they pay in $1 million worth of long-term care premiums, and they then have $8 million plus of long-term care benefit received tax-free. So, so those are the only two people that I have that have fully funded, have tried to fully fund, and their goal was to hand the long-term care policies to the kids and say, I want 24-hour home care, right? But most of us can't do that. So for those of us who can't, or would find that uncomfortable to just shed out $1 million for a long-term care premium, then the answer is you can either pick a benefit level that you want to afford. So I usually suggest 4 hours of home care. And that is so that when you enter into claim, you can say, let's just start the home care. And you don't try to do it yourself. And I should say, I'll even go down to 3 hours of home care, because if you needed home care, you would be typically willing to pay for 1 hour. And then you find, oh my gosh, I have to buy 4. And then you say, well, I'm not going to pay for 4. If I only need 1, I'll just do it myself again. And that's the beginning to the end, right? So we want to keep people home as long as they can, especially when finances are an issue. So having 3 hours of long-term care funded, that's a great policy. Once you get to 4, it's even better. And then people can choose based on the premium and their comfort level and their belief of utilization of this policy on how much more they want to cover.
Okay, another question came in. Can I buy just a home care policy versus one that's institutional and at home?
No, so we don't have home care only policies in Massachusetts. But it doesn't make that much of a difference, because as you see, home care is actually more expensive than assisted living settings if you need extensive care. So it's, there are many opportunities to use these policies in, home care, adult day health, assisted living, nursing home, hospice. There's an alternative plan of care. So that in the vast majority of these policies, so that if something comes up in the future, you could use that. I've had people who have used the alternative plan of care and policies to go to research centers. So if somebody has dementia, they don't want to go to an assisted living, they want to go to a research center where they can hopefully get better from their dementia, and that can be covered with that alternative plan of care. So what I was going to say that yes, I was going to say, no, you don't get just a home care only policy, but what you're choosing is how much money do you want, how much do you want it to grow each year, and how long do you want it to last?
Gotcha. And I know when I bought my long-term care policy, I bought a shared benefit as a joint with my spouse at the time. And I was on the young side when I bought my policy because felt like I needed to practice what I preach. when I was talking to clients. And they actually came out, even though I was young, the interviewer said, we usually don't come out to, unless people are over a certain age, but where you're young, we're suspicious that there's a problem.
Oh.
So has the underwriting process become more invasive when someone's buying a traditional long-term care policy, or is it just a phone interview, or how can you talk a little bit about that process?
Sure. So in many ways, it's become easier because of technology. So there is a tremendous amount of information in the cloud. So you don't know it, but every time you see a doctor, it goes up in the cloud.
Yeah.
Every time you get prescribed a medication, it goes up in the cloud. Every time you have an MRI or a CAT scan or any of these types of testing, goes up into the cloud. There's actually a new service out there that can even pull your lab reports and things like that, but that still requires additional authorization at this time. But when you sign the long-term care contract, you sign an authorization for the insurance company to go up into that cloud. And so when you fill out the application, you tell them what medications you're on and what your diagnoses are. They're confirming that by looking at the information in the cloud. So if you've seen like an oncologist, they're going to be pulling those medical records. You've been to an orthopedist, they're going to want those medical records, right? So you're on medications that are leaning towards liver disease, they're going to pull medical records. So they don't have to be as invasive in the home because they have much more information at their fingertips through the cloud. So if somebody is basically healthy and they've seen a primary care doctor once a year and they're not on any medications or nothing significant, they may be on, a little high blood pressure or cholesterol or thyroid medication, even anti-anxiety medication or a little bit of antidepressants. Those are just considered, just standard, fine medications, and they don't really worry about them, and they're just looking for stability. So if you're on medications and they're stable in any of those types of things, then they'll look at them, they'll pull medical records just to confirm everything is the way it's supposed to be, and you can pass through. The hybrids may or may not pull medical records depending on your age. And then, of course, some of these simplified issues or guaranteed issues don't pull medical records at all. Most of the companies will still do a cognitive screen because that is the biggest risk to an insurance company. Sort of it's catch-22, right? So the healthier we live, the longer we live. The greatest risk of dementia is age itself. So we live healthy into old age, and then we put ourselves at a higher risk for dementia, which is the greatest risk to the insurance company because you can live very long lives if you're healthy and you have impairment. So they do want to check very early to make sure that you're cognitively intact before they approve policy. So you will still see cognitive testing on the traditional and the hybrid policies.
And is that cognitive testing just questions or like read me back these 600 digits or something?
So actually they give you 10 words and you put them in sentences. And then they may do things like, what doesn't belong, an elephant, a horse, and, a pig, something like that. You pick which one doesn't fit. And then they'll ask you some other types of judgment questions. And then they'll come back and ask you what those 10 words were. They don't expect you to remember them all. I do tell people that these are not difficult, but they do challenge your brain. So you do want to make sure that you're in a quiet room, not distracted when you're doing your cognitive screening.
Gotcha.
Yeah.
Okay. Well, this has been fantastic. We all want to thank you for your time today, and you're open to people reaching out to you and
Absolutely.
answering questions. And we're going to send a replay to everyone that signed up. We had a little bit of a technical difficulty early on, so hopefully that didn't cause anybody any issues, but you will be getting a replay via email pretty soon. And if you have any questions, you can reach out to us here at Financial Planning Solutions or Linda directly on the long-term care side. So again, thank you, everybody.
Thank you for having me. I appreciate it.
Take care.
Take care.
Okay, everybody drop. Linda, she's still here. This Laura, she left. Okay. Oh, I guess Linda left too. So I guess we'll leave.